Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, April 6, 2022. It's 12:41 Eastern Time as I'm starting the video, and what I'm going to do is cover some of the recently highlighted trade ideas, including an update on the markets, and also some new things that I came across last night scanning the charts. All right, we're going to start out here with QQQ. Not much to add since this morning's post. That's what you call a reaction. We hit that level early on. We gapped down today, which is what you want to see for the bigger bearish picture, because remember, this right here and this was a rejection off the 200-day moving average, a back test from below. So to kind of recap, just real quick, for those of you new to the site or been with the site a long time but coming in, haven't checked in a while, we had this big 60-minute bullish falling wedge right there in blue. We broke out of it right here after putting in a big divergent low at that low. This line is supposed to be there. I have a lot of different boards covering that wedge. This one I had not extended the lines on. Effectively a double bottom low, and that's a very, very, very significant low. And as I said before, I think we'll take it out. And I think when we get even close to it, we'll probably just go on down through there. Really, the markets have no business visiting that after putting in a double bottom. Yeah, there are such things as triple bottoms, but again, based on everything that I've covered on longer term charts, I do think we'll get there. And I think as we start to approach it, we'll go on right through. In other words, I wouldn't try to game another bounce off it. All right, so what's happened more recently? We set up this bearish rising wedge. Posted last week, a week ago today, is a setup with a break on below the wedge to trigger sell signal. Had us going down here to that first target, which we hit, had us bouncing, and then going down here, and then bouncing again. I still think odds favor a bounce. I will say there's certainly a reaction. A reaction is I define as a consolidation or bounce. This is that level right here. Well, roughly. Again, remember, we're in a 350 plus point security. You know, we're talking, you know, every dollar is a fraction of 1%. So that's it. You can see we hit it this morning, and we've been consolidating all day. I think the odds still favor a bounce, but I'll tell you, the buyers certainly aren't stepping in with vigor like they were before. And bigger picture, and I said this, actually, let me make sure you got it. Hold on one sec. Just wanted to queue up the charts. From the post this morning, I followed up with a comment right after the post that I made, and saying, there was an updated view of the I posted the NQs in there as well as QQQ, but I realized after I get that post out this morning that NQ I had zoomed down to 1 month, so I put the 3-month chart. Just click and it'll expand. And then here's my thoughts. I'm just going to read them to you if you didn't catch that comment that I made. Keep in mind that the Nasdaq 100 was just rejected impulsively, that should read impulsively, off a back test of the 200-day moving average from below. In previous bear markets, which I believe this is, again, time will tell, and big corrections, think 2018 fourth quarter, I think COVID, because in my opinion those are just corrections, even though they were drops of over 20% in the Nasdaq 100. So in previous bear markets and big corrections, after that occurred, meaning a back test of the 200-day, and the 200-day you break it, that's bearish, back test, and that's usually the next big leg down coming. I said usually the next big and impulsive leg down began. As such, longer-term swing and trend traders with their eye on the prize, which are my additional downside targets on the weekly chart, might opt to ride out any counter-trend rallies at this time. All right, so I'm going to talk on that. We'll get to those charts here. Well, let's just dive in, get back there. So here it is. We're still at that level. We're at 351.55 versus, roughly 351.68 support right there. And there's still, and I think we'll get a bounce. We're getting pretty stretched. We're coming off a run of bullish sentiment right here with this rally, and when you look at how oversold we are on the 60-minute, we're coming down to this level here, that orange line right there. Where typically I'm going to circle every time we hit it, or even the blue line. Sometimes the blue line does the trick. I'm circling the orange line, blue line. The orange line did it there. Orange line, almost to the orange line there, not quite, and you can see what happens. So even in a downtrend, primary or intermediate term downtrend, those tags at that level result in a rally. Right now, the intermediate or shorter term trend, short to intermediate is up. But look, the charts are dynamic. I'll react if they take this level out. So far, it's been a consolidation, and so far the bulls have had many opportunities to step in and buy, and they haven't. So we could just consolidate there and drop on down through there. So again, as I said, longer term, this is to me, this is long term. This is the big picture, the weekly chart, and this says a lot right here to me. Turn off all the lines. You can just look. There was the take out of the 200-day moving averages. We back tested them there, rejected, and we just back tested again. So far, an impulsive rejection. And so if you aren't adept, or you don't have the time or the inclination to actively trade in and out, you want to swing trade, position trade, well, we had initial shorts were all up here, starting back here. We had plenty of short ops. Those are all still profitable. That was our next big sell signal. I mentioned every kickback we've had to the 200 days is objective shorting ops. And so again, you can, there's 100 ways, whether you're just shorter term swing trading. I talk about time frames. There's very active trading, there's day trading, there's short term swing trading 2-3 days, there's swing trading that you can hold positions for weeks, sometimes months, and then anything beyond that's pretty much trend trading. The trend right now, again, it's if your views align with mine, and they might not, and if they don't, then do everything in reverse. The levels that I'm saying that should cap the rally, like the 200 days, if we happen to get up here 379, 380, if those are taken out, then that's bullish, and that's where you can add to long positions if you are believing this market's going to new highs and beyond. Or maybe even just that marginal new high scenario that's still a potential scenario. We take out the highs and we still have big divergences. As of now, this remains and has continued to remain my primary preferred scenario. T1 was already hit right here. We got about halfway to T2, but that's still my second target, about 299 to 300 right there. T3 is about almost 270, a little below there. And the trend line comes in below, and then the final target, which is still the pre-COVID highs. That's where the market peaked back in February of 2020 before the drop. And again, these were measured from the high. That would be about, if that final target is hit, that's about a 42% drop. And then while the media has already called this a bear market in the Nasdaq, because we already exceeded the 20% threshold, that the traditional threshold, to me, again, even if my long-term target, and I know that's heresy to a lot of bulls calling for a 40% drop in the Nasdaq 100, but to me it'd still be just a correction in an ongoing bull market, because here's your bull market uptrend line from the late 08 to early 09 lows. That is just, turn off all the lines here, and that's all that would be, is just a pullback to test the primary bull market uptrend line. So look, if we get there, depending on the monthly charts tell me, I'm sure the buyers will step in. I'm sure there'll be a tradable bounce, or swing, maybe even trend tradable. But ultimately, if this level goes, then we may be in the early stages of a new secular bear market. But that's so far out. Let's not even bother talking about it, because we haven't even hit my second target yet. So when we get there, then I'll start turning my focus to the monthly charts. There's that same primary bull market uptrend line from the 2008-2009 lows, and so simply all I'm calling for is a pullback to that right now. And so again, while that 40% number might seem crazy to some people, to me it's just a correction, a mean reversion. There's our uptrend line, and every now and then you get away from it, and here's what happens when you come and visit it off the highs: 26%, 24%, 31%. That's all COVID was, is just a pullback to test the primary uptrend line. And my key big old 20-month exponential moving average on the monthly chart does a phenomenal job of defining bull and bear trends. When you're below it, that's where the big bear markets come. Last time we took it out with conviction and we got well below it was in 2008, and that's was followed by, from the high to low, a 55% drop. So that's why this time around things are going to be a little different, if I'm right, because if we're coming down to that to test the primary uptrend line, the only way to do it is to take out that 20 period monthly average. Now, if it happens very quick, you could do it in a month and get back above it. Just that's what happened in COVID. You can see the COVID hit. You had this big wick candle. I'm sorry, a tail they call it, the shadow, the skinny part, dropped all the way down there. But the end of the month, boom, they parked it right back above the 20-month. That's certainly a possibility as well. It would entail a type of mini crash type scenario. So, all right, big picture, small picture. You guys get the drift. That's where we're at. It's also support here on the daily chart we're at right now, and that's why, as an active trader, I think there's still a bounce trade to be made. How far? Minimum, I think, right here, 357 if we get a bounce. There's also a big old gap right here. Gaps love to be backfilled, and to do so would leave no unfinished business if we are going lower. Now, if we just crap out, it just shows, man, the supply-demand dynamics have shifted. We went from a very bullish tape to a pretty bearish tape in short order if this level goes. I don't have, let me give you one level because you can see right there, 342.90 is my next target. But I'm going to put one right here right now for you. This is a daily chart. We've got quite a few reactions there. It's minor support. It's decent because you had some reactions back here. In these reactions, that's about 346.76 is where that number is. So I'd still like to see this somewhere anywhere from there into here. So the bounce back target range for active traders, and then go on and take that level out. All right, so you are now up to speed on QQQ. For you NQ traders, same thing. This was laid out exactly a week ago today. I gave you this chart here. This is the bullish falling, bearish, excuse me. I'm going always long or short. Be thy neither bull nor bear, just trade the charts. But at this point in time, I'm bearish. So there's the breakdown. That was last Wednesday. The setup was laid out. There was your sell signal. And I also mentioned you could also short into resistance as well. Take it before the breakdown. And that's it. So we went down. We hit my first target. We bounce off the first target. Come down. We're on the second target where we'll likely bounce. And same thing. If you zoom in real tight, it looks just like QQQ or very similar. Of course, you have the round-the-clock trades on the Globex and Qs here. The Globex are the ones that, they're trading pretty much around the clock, shut down for a brief period each day. And that's it. So there's, it's decent support, just like QQQ, some support there. And if that level happens to go, then this is your next support, 14,294. So call that 14,300, give or take. And really no divergence or anything that tells me that we're looking at a much bigger drop, but we are getting a bit oversold here. This is where the RSI is. If I take that line across, show you the last time we were that oversold on the 60-minute chart of NQ was right here. So you could get a bounce, probably will, but not guaranteed. All right, that's it. All right, let's move on to other trade ideas. We'll stick with probably the most related one right now is our VIX trade. Added that as a long recently and rolled that from VXX into VIXY or UVXY. Remember, UVXY, you just have twice the juice. It's the same thing, but 2-time leverage. We started buying it right here and here were your objective entries. And so far, we're good for about a 15-16% gain. There's that 60-minute downtrend line, your bullish divergence, just like you had bullish divergence here when it did this. And so far, we're looking good. Not much else to add to that. There was our previous divergent low. Boom, you got that. And then for you futures traders, we are at a target we just hit. And see, this coincides with us hitting the support on NQ and QQQ. This was the same chart I gave you recently back here. We had this divergent low building. We had positive divergence, started a rally, had another marginal new low, but all it did is extend the divergence. So that only gives you a bigger divergent low, and then boom, it's been explosive. We ran up here, hit my first target right there, 24.90. Had a little bull flag. If you look closely there, you can see it. Bull flag consolidation right there. I think as I tighten up, you can now see it right there. And boom, ran up and now just hit my really more of a target zone. We can call it third target. It's a third resistance level. I had 26.42. And so you have the VIX at resistance with the Nasdaq 100 at support, Yeah, this is the VIX. It's not directly tracking the volatility. There is a Nasdaq volatility index, but it's not as liquid as the VIX. I'll just trade the VIX normally, and using these futures, I took profits here today, this morning. Reverse. Didn't reverse this. I reversed my NQs, which I'll go back in if I need to being short if the market tells me to. But as of now, still looking for that bounce, and from that divergent low here. That's what is that? I gotta move it here. Yeah, about the same thing, about 15% or so far. And again, long term, if you're keeping your eye on the prize, then we're probably going to go a lot higher. These are just the recent spikes that the VIX got to. So this is a big level right here on VIXY, and so another run up there. And this is, you can consider this a basing pattern right here. So if we can break out, boom, that'd be powerful. But you also want to watch the actual VIX itself. You get decay from the ETFs, or ETNs, I should say. This is a VIX on a daily chart. And you can see, and this is what I've talked about for a while now, despite this counter trend rally, which I still view as a bear market rally in the indexes, we're making a series of higher lows and higher highs. That's an uptrend. So we could blast on up here and hit these upper targets there on VXX or VIX. That's the actual spot VIX. All right, let me turn my focus to one other thing. I really like this. So recently, I gave you about a week ago, hard buys on silver and gold. I'll maintain those. We're still profitable. We nailed the bottom. Give you hard buys right here at this 1895 level on gold, and at the same time silver, and they're up. And I just want to do a quick update. Gold's holding this level. It's 1920 as support. It's really between this range right here. We had one little brief pop above it, but it's in this sideways range, and not far off support. So I still think it offers an objective long if you missed that entry last week, or if you took only a partial position. But your next buy signal is going to come on a break above 1957, so that'll be an objective long entry as well. Still like gold and silver. And also wanted to mention, at the time I gave you Treasury bonds around that same time, but I told you those were not hard buys. I gave you what I called a soft buy, as where there was work to be done. I'll tell you which one I like the most right now are short terms. I just bought today the 5-year Treasury bond futures. I'm going to show you, well, let me show you that chart, and then I'll show you an ETF for it. That is the 5-year bond is the, gosh, what's the contract? ZF. Let me queue up the chart. Give me 1 second here to find it. Here we go. This is a 60-minute chart. I'm going to show you the ETF and the 5-year Treasury yield in just a second here. But that is a textbook bullish falling wedge pattern right there. Positive divergence confirmed. It hasn't yet broken out, but I think it will. So I always say this: I take long trades in one of two ways typically. Either a pullback to support or a breakout above resistance. Now you don't see support here, but I'm going to show you something in a second. Breakout would be a break above the wedge, and here's my targets: 114.262, 115.313, and then finally 117 ish. Now what I think's going on is the market is probably, at least for the near term to the next Fed meeting, priced in what they're going to do. I haven't even looked. I think that, and you can Google it. It's called Fed Funds Futures. It'll show you, there's a chart that will show you the probability, what the market's priced in. And I think last I heard the talk was 50 basis points. The market's pretty efficient at figuring out what the Fed's going to do. So what I'm trying to get at, I think the near term is fully priced in. Long-term bonds, there's cross currents on the 30-year and 10-year, because you have, the Fed doesn't control. When they hike at the FOMC meetings, they hike the federal funds rate. They're not hiking the 30-year bond rate. They don't set that. The market sets that. The Fed sets the very shortest term rates, overnight rates, really. They don't technically set the 5-year bond either, but the shorter you go down on maturity on those bonds, the closer they're going to track what the Fed is doing. And so let me show you. So either way, there's your targets. If you trade futures, these are bonds, so you're not expecting triple-digit or double-digit returns. It'd be 3%, but they're leveraged, and the futures are leveraged. If you're going to trade the 5-year bond, I'm going to show you an ETF in a minute. You can do it, but you're going to have to take a lot of it to make it worth your while. Now, on the flip side, you don't have as much downside risk. So you can go into an overweighted position. I call that beta adjusted position sizing. It is, you take a very volatile, high beta security like a crude oil or natural gas. You need a smaller position size because you need to allow wider stops, and you're also going to have much higher percentage gains if you hit your price targets. And likewise, if you're trading bonds, you do it in reverse. You take more, or you use the leverage that the futures afford you. But let me show you my reasoning behind this one. This is what I covered a couple weeks ago when I covered the bonds. FVX. This is your 5-year Treasury yield. We're going to go to let's go to my longest term chart. This is my monthly chart. This shows you going back to the 60s. Look at that, 1960s. We were in a secular bull market for interest rates. That means a bear market. Remember, bond rates and prices always go inverse to one another. And so rates were rising up until the early 80s, beginning of the 80s. And then we entered a secular bear market in rates, which is a bull market in bonds. And there is a nice, well-defined downtrend line right there. We were walking our way down, lower and lower rates. This is when there was a bear market right here, so the Fed lowered rates when the dot-com bubble burst back in 2000 into the '02 low bear market. Then bear market ended, we started a new bull market in the stock market, and so rates went up. And then financial crisis hit, first zero rate policy and all the quantitative easing, then and everything that's happened since, followed by the nuclear reaction when COVID hit, where they just went all out, pulled all stops. So that's it now. Where am I going? Well, look where we are. We've had, to say that the 5 year is overbought would be an understatement. Yeah, I do think we're in an inflationary environment that's here to stay, and I do think this trend line will get taken out. And once we start taking out these previous reaction highs, we can say that we've started a new bull market in rates, which is a bear market in bonds. But with that being said, the initial tag of this trend line is likely to pull back, and that could be again, this is a monthly chart, guys, big picture. We could pull back quite a bit there, take the yield down. That would be bullish for the short-term bonds. Weekly chart looks like this. Get some divergence here if we can stop there. Oh, my line's just populated. You have divergence, and there's that same trend line. So the 5 year yield is at resistance, which means the 5 year bond is at support. The ETF, the closest one to it that I'm aware of, is IEI. That is the iShares Barclays 3 to 7 year Treasury bond fund. So basically they're targeting the 5 year. But what happens is it's a mutual or an ETF, so it's going to roll. It's going to hold different. They're not going to sell every time a 5 year now has 4 years left on it. They're not going to turn around and sell it because that leads to churning and raises their costs. So they'll hold them. And when they get down to 3 years, they jettison those and roll into longer term. So they're trying to keep an average and track the 5 year bond. And I haven't even marked the chart up. Really, I don't traded this one in the past. I really don't care for short-term rates, but short-term bonds. But in this case, you've got the case I just made longer term. So if you're willing to give it some room, I think there'll be some juice here. So basically what you'll probably be looking for, I don't know if it'll happen before or after the next Fed meeting, maybe to come back with a little bit more dovish rates, or maybe they give a 50 basis point hike and then the market says good, that's good for now. Maybe the stock market throws a little tantrum, whatever. It doesn't matter. It really doesn't matter. What matters are the charts here. So if that does happen, if this chart plays out, you're going to have a nice bounce and target up here. That would be, I think, comparable to what I just gave you on the futures. So with a stop along the way somewhere in there, there's a gap. So you can get the idea. Roughly, in that case, if it gets up here, about 3.4%. All right, so that's one trade idea for you, and it's also a way to diversify, having some bonds in there. It's a completely different asset class than equities. And now on to, I'm going to rifle through everything, guys, as I was going to cap the video here, but let's just do that. Okay, so recently I talked about my thoughts that we were in a bear market rally, and what happens is, once the market starts rallying, everybody thinks it's over, and that's the beauty of, if I am correct on that assumption, it gets everybody so bullish they think the worst is over, they dodged a bullet, and that's where you get that big impulsive next wave down. So just recently I pointed out that crap stocks are running. And this is an ETF I highlighted about a week or two ago called meme, and it obviously, as the name implies, it holds meme stocks. And I told you that AMC and GameStop and all the meme stocks are running. Well, they ran, and they've had a hefty correction, and just want to point that out. So that's kind of put the brakes on those lower quality trade ideas I threw out to you recently. Look, if you want a bounce trade, meme I just showed you, let me go back, is that back testing the trend line right there. I'm not crazy about it, but it is. I'm throwing out trade ideas for you. That's what you guys pay me for. So AMC, there's a support right here at $20. Remember, it ran up here. You had resistance at $36. It reversed a little shy. You had a big bullish falling wedge right there, just like the stock market did. The indexes, everything, it broke out, and it brought out back in those the Reddit crowd. But we're back down, so there it is. You can get a bounce trade right here. Go long AMC at $20 with a stop not too far below. Game the bounce and get out. I don't think AMC is going to continue much higher. Anything's possible, but I would only what I do is probably just trail it up, grab it at 20. It's at 20.07 right now. Stop somewhat below today's lows, maybe somewhat is relative to how far you think it's going to go. And you can either trail a stop, don't put a 1% trailing stop on something like AMC. It's going to clip you out even if you're right and it keeps going up. You need a little bit wider stop, or just set your stop a hard stop, and if it starts to pan out, you can raise it to entry, to at least assure a break even, and then periodically raise your stop instead of using a trailing stop. I think the little meme stock rally is over, so maybe a little dead cat bounce off there, and that's my guess. Just or pass if you don't want it. Of course, that's a given. AMC, and then GameStop is the other big meme stock, or there's several out there, but these are the two poster childs for meme stocks. It had bullish divergence as well, popped, rallied, and it's also pulled back to support. So you have GameStop, AMC, and that ETF meme all at support right now. The stock market's at support. And look, anything's possible. The market could just crater, fall through this support. These guys could as well. So, but I'm pointing out objective entries. That's all I can point out. I can't guarantee any trade will pan out. I can guarantee is if I think an entry is objective or not. And by objective, you buy support with a stop somewhat below. Trail it up, trade it however you want. All right, next up would be, I'm going to go through a handful of stocks that came across last night in no particular order. Some are long, some are short setups. AKI, I have never even heard of this one. It's a biotech stock, but I picked it up. I had some pretty high volume recently. Broke a downtrend line, has a level right here, 48 cents. It is a penny stock. It means aggressive. But if it can pop that level, it had a one-day intraday pop. But see that? That's a candlestick wick, aka shadow. And it means that it popped it intraday but failed to close above it. And so that's resistance. If it can pop it and hold that level, especially on high volume, I don't see anything stopping it till 71 cents. So it's high risk, very high risk. Call it a setup because it's not actionable right now. You had a divergent low right there, by the way, positive divergence, and it's walking up this uptrend line. So just one if you're interested. There's some levels, but high risk. Call it a gunslinger trade. RCON. Another one that's pretty low price. It's over $1, but not by much. $1.15. Divergent low. Breakout. Started a run. Recently pulled back, but it's still making higher lows, and it keeps popping on volume here. So I'm just passing along. I don't have any targets for you now. If you're interested, just drop me a line in the comments section. I'll study the chart a little further. TVTY, potential short trade, has a divergent high, but yeah, I didn't even want to cover that one. It's not, doesn't stand out too much. This one's been in the headlines recently. Twitter with Elon Musk, but what I'd say the big levels, if it can rally, I wouldn't touch it here. It's in what I call no man's land, but there's pretty big resistance right here. Price resistance about $58 and downtrend line resistance. So if it gets up here, I think it's a short. Until then, again, it's in no man's land. There's a big, massive gap below. It's between support and resistance. So I wouldn't touch it now. I'm just showing you levels because I know that's that one's been in the news lately, and I'm sure somebody listening to my voice has wondered about it. CLRD, clear day, little bullish falling wedge, low volume. When you see these wonky looking candlesticks, that's low volume, but it started to pick up volume recently. It broke out and it's been moving higher. Resistance here, let me give you a level there if it can get back up there. If it can pop that, about 365, maybe move up there. Again, low volume, not one of my favorite, but I'm throwing out trade ideas. Take them if you like it, pass if you don't. ALMN, American Lithium Metals, took out a trend line recently, but also came off pretty big support here. It's a penny stock. A lot of these lithium stocks are, but started moving up on volume recently. And I don't really have a target for you now. You might target that previous reaction high or just trail stops up. And obviously you don't want to let it go down below that 15, about 16-cent support level. There's the 10-year yield also at resistance. I didn't even mean to cover that. I just clicked my little space bar and advanced to the next security, but that also makes the case that the 30-year is probably ready to pop now, reverse the 30-year bond, meaning bond prices up, yields down. Where was I? ALM. Let me see which one, if I already covered. Yeah, I just covered AL. Yeah, that one was just there. Sorry, I'm looking at my scratch pad here and I have a lot of names, some I crossed out, some that I'm going over. AYI, Acuity Brands. This is a short setup. There's pretty big support right here at about 163.58. It's been dancing on that level. Boom, boom, boom. After putting in a divergent high, it's been stair-stepping lower like so many stocks. It is in its own bear market, despite whether you want to say the equity markets are or not. You really can't say the S&P 500 is, nor at this point in time the Nasdaq, at least in my opinion, but a lot of individual stocks are. I'm going to show you some more. So if it breaks that level, 168.50, it's probably going to go down here to at least 148 right there. So that's a short setup, untriggered. You need to have that sell signal kick in. RH, here's a long setup, potential long setup. It's at support. That's a gap right here. There's a big old gap from 2020 right there. We backfilled the gap right there, and we've been testing that level. That's 323.50, and you also have a downtrend line right there. Forms this wedge type pattern with positive divergence right there on the indicators below. Not crazy about the targets because we don't have hard resistance levels. I'd say about 390 to 50. And again, if the markets crap out soon, we're probably going to go down. And maybe if it goes down to that next support, we'll have divergence. We'll look at it again. Like I said, I'm just passing along setups. Some of these longs, some of these shorts, and like I said, pass on the ones that don't mesh with your outlook or your comfort level or trading style. Wanted to cover this one and then roll into the insurance stocks. You know what? I'll get to that one in a second. Let me just cover another one before I get to insurance, and that was Clovis, CLVS. This one busted out. Kind of missed it. If it pulls back, maybe a buy right there. There was a nice downtrend line, positive divergence, pop, broke out. It's been moving higher. It's at the first resistance here. Again, if you happen to be in this or looking at it, I think it can work its way up to $4, but it's at resistance now. So maybe on a pullback, if it pulled all the way back there to $2, that might provide an objective entry. But right now it's in no man's lands between support and resistance. Insurance companies stood out to me. UHIC. Nope. What was that one? 1 second. Okay, this is UIHC. It's not one of the bigger ones, but it's still a good sized insurance company. I'm going to focus on the weekly chart here and show you this is a concern for the markets. A lot of these big insurance companies. You can see when I go out to the long-term chart, see this was a divergent high. You can see my negative divergence, positive divergence there, leads to the rally. So these are the big trends in the stock. Divergent low, divergent high. That was actually a divergent high. I didn't have it marked up. I just found this one last night. There's your negative divergence at that point. And of course, divergence isn't a sell signal. You see a little bearish rising wedge right there. And that's at the trend. Now, this guy has been clearly in a bear market. In fact, it's been in a bear market since 2014. And I wanted to show you this right here. You had a big divergence, positive divergence, but it was bear market divergence. I talk about this a lot, and I've talked about this in the stock market recently with that 60-minute bullish falling wedge on the indexes that I pointed out well in advance before it broke out, as it broke out, and afterwards. But what happens is positive divergence in a bear market, you can see it led to a bear market rally, and it was powerful. If you traded it, great, but it was 80%. But guess what? When you look at the bigger picture, all it was is just another bear market rally. And relatively speaking, as far as Fibonacci retracements and all that, that 80% rally dwarfs the drop that it's had since then. The stock is down since it peaked years ago 90%. You would have lost all your money. And if you had, bought it back here, let's just say, that 80% rally wouldn't have done squat on getting you back to where you were. It sounds impressive, but I talked about this a lot. If a stock drops 50%, let's say, you don't have to make 50% to get back to where you were. You have to then make 100%. That's how the math works on it. So just wanted to point that out. And in doing that, let me show you something. Obviously, what's the point? Well, to show you that in bear market rallies, divergences usually don't pan out for much more than just a counter trend bear market rally. But here's a bunch of setups. This is the largest in the watch list here. This is Chubb. This is what is it, a $92 billion company, big company, big insurance company. Here it is. Look at that, beautiful, bearish rising wedge pattern. On a weekly, I'm on a weekly time frame, so this paints the big picture. By the way, again, I didn't mark all these up because I just found these last night. But that, last time you had just moved my trend line, didn't mean to do that. Last time you had a bearish rising wedge on the weekly time frame with negative divergence was, well, the last time was right here when COVID hit. You can see that. There was your trend line, you broke it, you're back to put in a divergent high at that point in February, right before COVID hit. And that divergence was followed by a 48% drop. Go back to 2017, you had divergence right there. I have to come here to measure down to the bottom. That was a 26% drop. Yep, you got it. Divergent high back then. So all I'm showing you is this is technical analysis. The way I view it, it's pretty simple. There are no guarantees, but when you can, to me, the whole point of technical analysis is identifying chart patterns, similarity in charts to other points in time, and if you have enough data points, you can extrapolate with a good degree of confidence or certainty, not 100%, but a good deal, that what's going to happen. And so you see this divergence building, and there's no sell signal. You had divergence here, you had it here, you had it here, but you have a nice clean uptrend line. So when this trend line breaks, and I should go ahead and I'll do it now, set an alert. The rest of these, I'm only going to show you a handful. I'm not going to go through every one because the video's gone long enough. Second largest in the watch list is PGR, Progressive. Great insurance company, great company, but it's walking its way up here. Got a nice trend line, and then boom. So when it breaks that, you're looking at a bear market in Progressive. It's probably going to go on to hit these three targets I've laid out, about 85, 72, and 57, 60 or so. Travelers. Again, birds of a feather flock together. Same story here. You've got these divergences, you have wedges. Obviously, I can lay targets out. And look, we don't have sell signals yet, but to me, just the look of these wedges, they're ripe. They're pretty much fully formed, and to me, it appears to be a matter of time. It looks like a breakdown is imminent. Imminent relative to the time frame. When I'm not on if I'm on a 5-minute chart or a 60-minute chart, I tell you a breakout looks imminent, it means within the next, within hours to maybe days. On a weekly chart, obviously that could be weeks, even months. But that's what I'll look for. I'll just set one more alert. And what's going to happen, I'll probably forget about these guys until these alerts go off, and then I'll revisit these charts, and then I'll probably do a video sharing these. Now you can replicate these charts, and in some cases, I'll even start building short positions when a setup looks so good that it looks like a breakdown is imminent, and then I'll start layering in, and then add to, of course, as you get the sell signals. All right, I think that's it. Let me pause the video and just look over my notepad. Yeah, that's it. Long enough. All right, guys. So to summarize, looks like still favoring a bounce here on QQQ. Has been holding that support all day long. But bigger picture, until unless we take out the 200 days with conviction. What does conviction mean? Solid weekly close, especially a second close. We take out the 380 level on QQQ. Until unless that happens, this could prove to be a very nice shorting op. But if you didn't short already, don't short now at support. That's what I'm trying to say too. If you didn't take this sell signal that we had, or short either into the resistance the last week, or the following subsequent sell signal which we had, or even the kickback rally that we had after that, you don't short now. Now we've dropped in just a matter of days. We're oversold in the short-term chart. We're down 5% in just a few days here, and you're at support. So at this point, if you say, oh gosh, Randy, I didn't want to short the other day because this rally looked like it was too powerful and just nothing but bullish, well, that's when you want to short. But if you didn't, then at this point in time, you wait for a kickback to that bounce target zone I gave you earlier in the video there. And then you can either have tight stops, or you can have stops above the recent highs, or you can use stops based on that daily or weekly chart I just showed you. Or if you're bullish, go long when these levels get taken out. Take out those every level that I just showed you a minute ago on the daily and weekly that quote unquote should cap this advance, which includes, not limited to, I didn't mention it in this video, but I'll do it now. There was a 61, I told you last week, we rallied right up to the 61.8% Fibonacci right there, which is the drop that measures the drop from the entire highs from back in November in the Nasdaq 100 down to the recent lows. That is a 61.8% retracement there off the entire move down, which is a key Fibonacci level, a key place to layer back into. And really, to me, usually that's about it's not set in stone, but that's usually about the maximum bounce in a counter trend rally. You usually bounce anywhere from 38 to 32 or 38.2% fib up to the 61.8, and so far that's what we did and got rejected there. Okay, I am done. This has been Randy Finney with Right Side of the Chart. Have a great day.